I suspect that the period of declining interest rates, as we've seen in the last year, is over. We've benefited, arguably, for 40 years from declining interest rates. And the simple fact that the interest rates aren't declining anymore but increasing presents us with at least two problems. The first is that the U.S. government has been having trouble servicing its debt at artificially low interest rates. And the interest charge paid by the U.S. government on its benchmark security, the U.S. 10-year Treasury, has doubled in the last 12 months. If they had trouble servicing their debts at 1.75, think about the problem that they're going to incur servicing their debts at 3.75 or 4 or 5. Servicing $26 trillion in net debt is no trifling matter, particularly when you combine that with unfunded liabilities. But the other problem, in addition to increasing nominal interest rates, is continued negative real interest rates. Let's look at the arithmetic around the U.S. 10-year Treasury from a buyer's point of view. The U.S. government currently promises to pay you about 3.5% on a 10-year bond in a currency which the Congressional Budget Office notes is losing 7% a year in purchasing power. So the U.S. government unequivocally promises that they're going to cost you 3.5% of your purchasing power a year for 10 years. My friend Jim Grant calls that return-free risk. And I would argue, Maggie, that gold is fighting primarily an investment which promises you return-free risk. By the way, this is the first promise I have heard from the U.S. government in my 70 years on the planet that I have absolute faith they will keep. They will destroy my wealth in the U.S. 10-year Treasury. I'm certain of it.
So how do we plug in the current situation with the Federal Reserve and interest rates? Because one of the big debates facing everyone as they try to figure out, and try to look for upside is whether the Fed's going to pivot, whether we are higher in a regime of higher interest rates or whether we are going to see them turn tail and lower rates again. How do either of those scenarios potentially impact gold? What do we need to understand about that relationship?
With the caveat that I'm a credit analyst, I'm not a political analyst. I'm not an economist either, by the way. My fear is that the impact of higher interest rates on the economy hasn't been felt yet. My fear is that the economy is geared around cheap and plentiful credit, and that the economic impact of the increase in interest rates that we've seen in the last 12 to 18 months hasn't been fully felt in the economy. We're seeing a circumstance now where the transactions, as an example, in single-family housing have slowed. The buyers believe the prices are lower, and the sellers aren't willing to take lower prices for their house. Usually that conundrum in the face of higher interest rates resolves itself in lower real estate prices, which should, I suspect, impact new home construction. Higher interest rates, too, over time, might impact consumer credit, particularly spending on consumer durables. And they will certainly increase the cost of capital for American companies. If the impact of higher interest rates begins to be felt more thoroughly through the economy, by the way, I'm very impressed so far by the durability of the U.S. economy, favorably impressed. But if the impact of higher interest rates lags, as it has in prior cycles, I suspect that the political pressure, both from voters but also from the powers that be, would be, in fact, for the Fed to pivot, for the Fed put to be exercised, for quantitative easing to resume, and for the interest rate to be lowered. If that were to happen, two things would happen. The delta between the rate that savers received for saving and the purchasing power of the dollars that they got paid back, which is to say the real interest rate would fall at the same time that the Fed would have signaled its intention to give way to inflation in favor of politics. Were that to occur, by the way, I watched that occur myself in 1975, I think that the circumstance would be dramatic for gold. Your older listeners, Maggie, might recall that in the period of the 70s, the gold price had a great romp from a price-controlled $35 an ounce to $200 an ounce in early 1975. In 1975, the Fed began to tighten, and they tightened quite aggressively. The consequence of that was that the gold price fell from $200 an ounce to $100 an ounce, a 50% decline in a year. But the economy buckled. And as the economy buckled, the Fed reversed course. And when the Fed reversed course, gold went on a romp that took it from $100 an ounce to $850 an ounce in 6 short years. I'm not suggesting that a Fed pivot would generate a gold move that was an 8-fold move, anything like as dramatic as a move that took place in 1975. But I think that the direction might be similar. And I think that for a variety of reasons that we can go into later.
So a pivot is potentially bullish for gold. What about if the Fed surprises everyone and continues to inflation stickier and they continue to hike rates and they choose the fight over inflation? What does that do to gold?
I suspect that what will move gold will be real interest rates, which is to say the difference between the deterioration of the purchasing power of the dollar and the compensation that savers get for lending the U.S. government money. But 2 other factors, of course, come into play. The first is the one that we talked about, which is to say the credit quality of the issuer. At some point in time, the ability of the issuer to maintain some form of purchasing power gets called away by inflation. But there's another question that we need to talk about too, Maggie. One of the important buyers of U.S. government debt for the last 60 or 70 years has been non-U.S. entities, in particular foreign central banks and foreign governments. 2 things have happened to shake the faith and the loyalty of foreign creditors to the United States. The first is the value proposition that we talked about earlier. Can these countries, by investing in their own economy, generate a real rate of return higher than minus 3.5? Often, as in the case of China, the answer to that is yes. But a second thing has come into play, I think, which is the weaponization of the U.S. dollar. The U.S. dollar, remember, is the world's reserve currency. It's the way that the world trades with each other. It's the way that the world stores value. And the U.S. government has chosen to weaponize the dollar. They've chosen to restrict access to the SWIFT banking system to regimes whose priorities are different than the U.S. priorities. They've chosen to attempt to influence and, in fact, extraterritorialize U.S. policy on other countries by weaponizing the U.S. dollar. Not a great way to encourage your customers. In the beginning, the criticism of this stemmed from countries which we believed, for often good reasons, were overtly hostile to us. Iran, Russia. Then it began to go to countries that were perhaps lukewarm towards us, say China, say India, say Pakistan, say Brazil, say South Africa. Now it's gone, in fact, to the Saudis, who have been steadfast allies of ours for 50 years. The weaponization of the dollar and the impact of negative real interest rates on U.S. government savings products, I suspect, will lead to a global lessening of the market share of U.S. Treasury securities among foreign holders, both as a store of value and as a system of exchange. I am not one of these, Maggie, who believes that some new mythical fiat currency or some cryptocurrency will dethrone the U.S. dollar. That isn't what I'm suggesting. I suggest that the U.S. dollar will be the primary medium of exchange in the world for at least 20 more years. But I think its market share will decline. And I think one consequence of that is that the market share of gold in international transactions will increase. I know personally from discussions with my former employer with very, very, very large foreign sovereign wealth funds that although they don't trust the U.S. well, they trust each other less. They are unlikely to do large amounts of trade in currencies and for securities that they don't control. The U.S. dollar is still the deepest and most liquid market in the world. It is the best of a bad lot. But the second best, I think, is gold.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.